All right, so we're still in chapter 3, and we're going to go over some more homework today. And we should be finished with chapter 3 today. Now, the homework isn't due until the 16th. So that's not this Friday, that's a week from Friday. So you still have plenty of time to get your work done. I can see about half of you have started, right? So there's about half of you that haven't yet. So, don't wait, because these problems are longer and they will take you more time. As you'll see today from this problem we're doing today, this is problem 4. And this is on page, it's the 4th problem we have, but it's problem in the book. It's problem 3-8. And I like this problem because it reviews everything that we've done from the beginning. So if I read this out to you, if we read this out, the general ledger of Red Storm Cleaners at January 1st, 2021 includes the following account balances. Right, so here you have a trial balance at the beginning of 2021, or you could actually say the end of 2020, right? These are the accounts, and these are the balances. Now notice when you look at this, these are all balance sheet accounts, aren't they? Assets, one liability, stockholders' equity. So when I look at that, I don't see any revenue accounts. I don't see any expense accounts. That tells me what must have happened, that the accounts were closed. Remember we talked about closing the accounts? So you always close the accounts at the end of one period so that you start out the next period with 0 balances in the revenue accounts, the expense accounts, and the dividend account, right? So that's the first indication of what's going on. The following is a summary of transactions for the year, right? We can see it's a summary of transactions, right? It's not each individual transaction, it's a summary. So the first thing they want us to do is to record these transactions listed above. Then you can't see this on this screen, but if you look at the book, record the summary transactions listed above, post them to the accounts, prepare a trial balance, record adjusting entries, post adjusting entries, prepare an adjusted trial balance, prepare an income statement and a classified balance sheet. For some reason, they didn't ask for a stockholders' equity statement, right? So we might have to do some calculations on the side, maybe. I don't know. Then they want to record closing entries, post-closing entries, prepare a post-closing trial balance. So that is the entire cycle. That is everything that we have learned going back to the beginning. All right, so if you can do this problem, you know your stuff. So let's take a look. Let's go in order. I'm going to expand the screen to make it easier to see. Okay. So the first thing, provide services to customers of $60,000. Now, as soon as you see provide services, what do you think of? Revenue, right? Revenue. And this is a cleaner, so this is service revenue. So the first thing I'll do, let me put this in here. Service revenue, $60,000. Okay, now they tried to be tricky here. They told you provide services to customers, $60,000, $21,000 on account. What does that mean? When you sell something on account, that's accounts receivable, right? So accounts receivable is 21,000. Now, if I stand back here and look at this, we know that for every transaction, the debits have to equal the credits. So if I got a debit of 21 and a credit of 60, that means I need another debit of 39, right? Because that'll add up to 60. 21 plus 39 add up to 60. What do you think that 39,000 is for? When you provide services to customers, you can either do it on account or for what? What's your favorite word?
Cash.
Cash. See, I got a fast answer there, right? So debit accounts receivable for 21, debit cash for 39, credit service revenue for 60,000. Let's record that. Now later we're gonna, it doesn't let you jump. I would love to put these numbers in the accounts, but it doesn't allow you to jump. So we have to go in order. It's a little awkward. It would be nice to look at the accounts and see. They do give you a list of the names of the accounts in the problem. If you look at the problem, which was on page 164, under the requirements, number 1 says set up the necessary T accounts, and it gives you the names of the accounts, right? So you can look at that list to make sure you're using the right accounts. So now number 2, collect on accounts receivable. Well, when someone owes you money, what are you going to collect? Again, your favorite account, right? Debit cash and credit accounts receivable. Issued shares of common stock in exchange for cash. Well, there's cash again. Right? And credit common stock. Right? And these are all transactions that we've seen before. Okay, now here's a tricky one. Pay salaries. So whenever I see the word pay, that means credit cash, right? Whenever I see that word pay. Pay salaries $7,500 from prior year. Now, as soon as you see prior year, you should start to think what? Liability. So look at your trial balance. You have an account called salaries payable, $7,500. That's what you're paying. You're paying that $7,500. So it's not salaries expense. If it was salaries expense, it would be the current year. But because it's the prior year, it's salaries payable. That was kind of a dirty trick, I think. Pay means credit cash. Pay repairs and maintenance expenses. Repairs and maintenance expense. And pay always means credit cash. Purchase equipment for cash. Purchase equipment for cash. Debit equipment, right? And the word pay tells you to credit cash. Pay dividends. Pay cash dividends. So again, the word pay always tells you credit cash. So that means the debit has to be to something else, dividends. Remember, the words are very important. The words tell you what to do. So even if you have like brain freeze or you forget or whatever, if you can just remember a few basic things, right, it can get you through. Okay. Was that the last one? Usually dividends is the last one. Okay. So now let's look. All right, so now go back and take a look and see if there's anything you want to change, right? If you want to change something, you can see the little pencil here that allows you to edit. But if you're satisfied that you're right, do check my work. And then look for your green check marks. And it looks like everything is correct. All right, so now we can score the answer. All right, so that part of the problem is complete. All right, anything you want me to, any questions, anything you want to go over? Yes? Are you alive out there?
Yes.
Okay, good.
Yes.
Because every once in a while it gets so quiet, I think I'm alone. Okay.
I have a question.
Sure.
So for the March 12th, you subtracted the 21,000 for accounts receivable from service revenue to get cash?
Yeah. Yeah,
Okay,
you see, for every entry, the dollar amount of debits has to equal the dollar amounts of credits. So if I know this is 60 and I know this is 21, this has to add up to 60, right? So that's how I come up with the 39. I say 60 minus 21 is 39. And then you just have to know that when you get revenue, that means you did work for somebody. They either pay you now or pay you later. If they pay you later, that's accounts receivable. If they pay you now, that's cash. So even though they didn't tell you cash, they were assuming that you could have put the concepts together and figured that out yourself.
Okay, thank you.
All right, anything else? Because we're going to go on to the next part. All right, let's see what they throw at us now. See, now what I would do is I would put these numbers in the accounts, right? But I don't know the order they're going to take us, so let's see. See, now they just want us to do a trial balance, and without seeing the accounts, it's not easy. It's not easy. So we're going to have to do some, let me see. Let me see if we can do something here because you have unlimited attempts, right? Let's see if we can, we'll get zeros. We'll get zeros. But I want to get to those accounts. I've spoken to them about this and they keep telling me they're going to fix it and they haven't fixed it yet. All right, so the last thing they want you to do is the accounts. So they go out of, right, I'm just hoping we can come back and fix this. Okay, now here are the accounts. All right, so what we should do is enter the balances that were on the original trial balance. If you go back to the beginning of the problem, you see these amounts? We should enter these in the accounts right now. So cash was 20,000. Accounts receivable was 8,000. Supplies was 4,000. Equipment was 15,000. Accumulated depreciation. Now remember, accumulated depreciation has a credit balance, right? A credit balance. That's 5,000. Salaries payable, liabilities have credit balances, 7,500. Common stock has a credit balance, right? Common stock credit balance of 25,000. And retained earnings, a credit balance of 9,500, right? So those are all the numbers off the trial balance that they gave us at the beginning of the problem, right? Here. So now we made the entries in the journal, and now we're going to take those numbers from the journal entries and put them in the accounts. So March 12th, right? Remember March 12th? That was the debit to accounts receivable of 21,000. The debit to cash of 39. And the credit to service revenue. See it here? Credit to service. I'm going to put 0 here because again, this is a computer and, you know, sometimes they're expecting to see things. This was service revenue was 60,000. In fact, let's put zeros in the accounts. Okay. All right. Now that second transaction, May 2nd, collect on accounts receivable 18,000. So May 2nd, that was a debit cash of 18 and credit accounts receivable of 18. Then on June 10th, issued shares of common stock. June 10th. What was it? June 30th, I'm sorry. June 30th. Debit cash for 6. Credit common stock for 6,000. Then we had August 1st, pay salaries from 2020, prior year, right? That was this debit to salaries payable. What was the date again? August 1st. August 1st. Debit 7,500 and credit cash 7,500. Pay repairs and maintenance 13,000, so we should have repairs and maintenance expense 13,000. And credit cash. Purchase equipment, October 19th, purchase equipment. $8,000 cash. Debit equipment. Huh. We ran out of room. Well, let's see. Let's put this 7,500 up here, see what happens. Okay, so it won't let me do that. Let's put
Can you
it,
just use the 3 lines above?
yeah,
Those.
yes, that's what we'll have to do. So the 7,500, what date was that? That was August 1st. So I can get rid of that. Okay, the 13,000. September 25th. And this one we just did now, the equipment was 8,000. And that was 8,000 was on October 19th. Okay. We got a newcomer. Okay. Okay, and then with the last transaction was the pay cash dividend. Where's dividends? Here it is. That was December 30th. Debit dividends. And credit cash. Okay, and it looks like they were very nice to you and they did the math for you in the accounts, right? So they figured out what the balances were for you. Okay, now let's see. Now I want to go back and I want to do a trial balance. So I'm going to need to use these numbers, right? Cash, 53,400, accounts receivable, 11,000, supplies, 4,000, equipment, 23,000, accumulated depreciation, 5,000, salaries payable, 0, common stock, 31, retained earnings, 9,500, service revenue, 60,000, dividends, 1,100, salaries expense, 0, repairs and maintenance, 13,000, depreciation, 0, and supplies expense, 0. Okay, so let's see if it'll let me go back. Previous. Oops. Okay, here's the entries. Here's the trial balance, right? So let's see if we can go back and enter those numbers. Let's see. Now, why won't it let me put the numbers in?
You try exiting without saving and coming back.
How do you do that? Well, maybe I got to click submit. Wait, let's see. Okay. Yeah, I don't know why it's not letting me do that. So should I exit and come back? Is that what somebody said?
You try it.
Because I could just click on this, I think, and it'll show you. right? So these were the numbers that were in the accounts. Right, so the debits equal the credits. That's the purpose of the trial balance. And now we can move on to the next part, which were the adjusting entries, right? And again, I just fast forwarded through this to get to that thing. I've got to call them again and see what's up with this, because this is disturbing. All right, so let's go over the adjusting entries. And there are only, looks like there's 3 of them. Right, looks like there's 3 of them. Record adjusting entries. Accrued salaries at year end amounted to $19,600. So that would be a debit to salaries expense and a credit to salaries payable, right? Debit salaries expense, credit salaries payable. The depreciation for the year on the equipment is $5,000. Debit depreciation expense, credit accumulated depreciation for $5,000. And then the supplies remaining on hand at the end of the year are $1,200. You need to look at the supplies account. The supplies account right now has a balance of $4,000 shown in it. But if there's only $1,200 left, that means $2,800 were used. Debit supplies expense, credit supplies, $2,800, right? So that's what this should show you. Debit salaries expense, credit salaries payable. Debit depreciation expense, credit accumulated depreciation. Debit supplies expense, credit supplies. Right. Now we should be able to go to the accounts again. Okay, and notice where the red marks are. This is where the adjusting entry should have been. Right, so remember we had 3 adjusting entries. Debit salaries expense, you should see a red mark in salaries expense. Credit salaries payable, there should be a red mark in there. See it? Debit depreciation expense. Credit accumulated depreciation. See the red? Debit supplies expense. Credit supplies. All right, so now if I click that, the numbers will appear. So remember the 3 adjusting entries: debit salaries expense, credit salaries payable. See the entry? Debit salaries expense, credit salaries paid. Now again, it's showing you after closing. So again, okay. So now they wanted the adjusted trial balance. All right, so here's the adjusted trial balance. And enter the amounts off your accounts, right? And remember, the only balances that are going to change here are the accounts that were adjusted. So there were 3 adjusting entries, 1 debit, 1 credit. There's 6 accounts that will change. And remember, you never adjust cash, right? A common error students make is to adjust cash. And you never adjust cash, never under any circumstances adjust cash, right? And as practical matter, you're never going to adjust the stockholders' equity accounts. You're never going to adjust retained earnings, for example. The only time retained earnings ever gets touched is during closing, right? Remember, during the act of closing. Right, so now the next thing they want us to do after doing the adjusted trial balance is to prepare the income statement and balance sheet. income statement. See that, and again, that's a nice thing about the trial balance because it puts the accounts in order, right? The balance sheet accounts are on the top and the income statement accounts are on the bottom. So to do an income statement, here's your revenue, right? Here are your expenses. So all you have to do now is go to an income statement, right? And put them in. So service revenue, 60,000, list the expenses. Total expenses were 40,400. Net income is 19,600. Okay. Right now, they didn't ask us to do a stockholders' equity statement. Maybe on a piece of scrap paper you could. Right? They wanted a balance sheet next. Now remember, the balance sheet are the accounts that are, wait, what happened? The balance sheet are the account, here they are, okay. The balance sheet is the accounts that are left. Assets, right, and notice the assets are divided into current and long-term. And what's the difference between current and long-term, right? In accounting, it's 1 year. If something takes you more than a year to do, it's considered long-term. If something takes a year or less to do, it's considered current. So when you see things like current assets, these are all assets that are going to be either cash or converted into cash or consumed within the next year. Long-term takes more than a year. So what's the difference between supplies and equipment? When you buy supplies, those are things that you intend to use right away, like a pencil, for example, right? And equipment is something that you intend to use for a long time. Say like a computer. You buy a new computer, you're going to keep it for 3, 4, 5 years, maybe even longer. But that pencil is only going to last you a few weeks, if that long. Same thing with liabilities. Current liabilities are liabilities that will be paid within the next year. So salaries payable, right? Your employees don't like to wait too long to get paid. That's always going to be current. There were no long-term liabilities in this problem. All right, now, common stock we knew, right? Common stock when we started was 25,000 and we sold 6,000 more. So common stock was 31,000. And again, your account shows you that. But your retained earnings account, at least right now, it won't say 28,000. Your retained earnings account right now says 9,500. So what would we have to do to that 9,500 to turn it into 28,000? We would have to add the net income. The net income was 19,600, and we would need to subtract the dividends. The dividends were 1,100. So if I take 9,500 plus 19,600 minus 1,100, that should be 28,000. So that's where that comes from. Another thing you could do, let's say you didn't want to do that, right? Let's say you knew everything on this page except this 28,000. Could you back into that 28,000? In other words, if you know that assets equal liabilities plus stockholders' equity, could you figure out that 28,000? And the answer is you could. Because if this number is 78,600, then that means this number has to be 78,600. And this 78,600 is made up of what? It's made up of this 19,600 and this 59,000. So if I take 78,600 and subtract 19,600, that'll give you the total stockholders' equity of 59,000. Now, stockholders' equity is made up of common stock and retained earnings. So the total of these two has to come out to 59,000. If you know this one is 31, 59 minus 31 is 28, right? So you could figure it out that way too. Now, after the financial statements, they want closing entries. Closing entries. And remember, to do the closing entries, we really want to look first at the income statement. Now, closing means making certain account balances zero. And again, why do we want to make certain balances zero? Because we want to start out the next year at zero. An income statement measures a period of time. Once that period of time is over, we want to make those accounts zero. So the revenue accounts are zero, the expense accounts are zero, the dividend account is zero. So we have three closing entries to make. First, we want to close the revenue, then we want to close the expenses, and then we want to close the dividend. Right, so here's the space for the entries, right? Close the revenue, close the expenses, close the dividends. Now, to make something zero, you have to do the opposite to it than it normally is. So, for example, if a revenue account has a credit balance, to make it zero, you have to debit it. Expense accounts have debit balances. To make them zero, you have to credit them. The other part of the entry is to retained earnings. All right, so let's take a look at the answers. Debit service revenue, credit retained earnings. That makes the service revenue account zero, and it gets the revenue into retained earnings. Remember what retained earnings is what? The balance of retained earnings is net income minus dividends. And what makes up net income? Revenue minus expenses. So this credit to retained earnings, this gets the revenue into the retained earnings account. Then the second entry is to close the expenses. Because we had an income statement, we knew that the total expenses were $40,400. Debit retained earnings, $40,400, and then credit each of the expenses. Then the third part, close the dividend account. Debit retained earnings, credit dividends. Remember, dividends is an account that has a debit balance. So if we want to make that zero, we have to credit it. And we know that dividends reduces retained earnings. Therefore, that's why there's the debit. Remember, with retained earnings, debits decrease and credits increase. The other thing that the closing entries do, which is just as important, is it's the only way you can change the balance in retained earnings. Remember, when we started this problem, retained earnings had a balance of $9,500. But by the time the problem is finished, retained earnings has a balance of $28,000. So this is how the balance changes. All right, so here's the accounts after everything, right? After all the closing, right? And remember, closing just affects revenues, expenses, and dividends, right? So you can see that dividends is zero, revenue is zero, and all the expenses are zero. The ending balance is zero. We have one more step. We have to do another trial balance, right? So go back to your accounts and do your trial balance. Okay, which we can actually do, I think. No. All right, so what goes on this, what's called post-closing trial balance? The word post means after, what comes after post-closing trial balance? Just the assets, liabilities, and stockholders' equity, right? Because the revenues, the expenses, the dividends are closed. So all that's left is assets, liabilities, stockholders' equity, and notice retained earnings is now the right number, the 28,000. So, you know, this is kind of a long problem, but I think it's very worthwhile to do because you get everything in there. Now, on an exam, you're not going to get a question like this, right? So don't worry. It would take too long. And the thing that I don't like about these problems on exams is that if you make a mistake in the beginning, you'll just carry it through the whole problem, and then to go back and fix it can make you feel insane, right? So on an exam, these problems are not good. But when you know, for homework where you have unlimited time and unlimited attempts, I think it's a good exercise. Right now, does anybody have any questions about any of this? Hold on, I'm going to close the window. I hear a leaf blower. I moved from a house to an apartment, and I'm still learning to deal with noise other people make. Although even when you have a house, you have people with leaf blowers and lawn mowers and things like that, which is can be very loud. Any question on any of this? Okay, let's see. We have time. Let's see if we can do something else. Adjusting entries are the things that make people crazy, right? So let's see if we can do some more adjusting entry. Okay, well, again, I'll do it with you here. Let's see. No, that's not what I wanted. Okay. Now, in the in your book, I'm looking on page 155, exercise 312. Okay, exercise 312. Below are transactions for Wolverine Company. Wolverine Company during 2021, right? And then look at the requirements. Record the necessary adjusting entries at December 31st for Wolverine. You do not need to record transactions made during the year. That's another common mistake people make, is that when they see the adjustment, they record the first entry, not the adjustment. Right now, again, on a piece of scrap paper, if you want to do that, just so you get an understanding of what's going on, that's fine. But that's not the answer they're looking for. They're just looking for the adjustment. Assume that no financial statements were prepared during the year and no adjusting entries were recorded. So that's telling you they're looking for a full year's worth of numbers, computation. Okay? If they were preparing financial statements monthly, then we would only be interested in 1 month. If they prepare financial statements quarterly, then we'd be interested in 3 months. But because they're only preparing financial statements once a year, that's what we're going to be concerned with, calculating things for a 1-year period or from the date that something started through the end of the year. All right, so let's take a look. On December 1st, 2021, now that's almost the end of the year, right? How much time is it between December 1st and December 31st? 1 month. Wolverine receives $4,000 cash from a company that is renting space from Wolverine. The payment representing rent for December and January is credited to deferred revenue. So on December 1st, they debited cash and they credited deferred revenue. What entry are we going to make on December 31st? Well, that $4,000 represents 2 months, December and January. So 4,000 divided by 2 is 2,000, right? So let's see if we can make that entry. The date on these things, right? And these problems are good to do. You get more practice. So this was exercise 3-12, right? Which was on page 154. So the adjustment is on December 31st, right? And what account are we going to debit? What do you think? What account do you think we should debit? Anybody? Nobody? Okay, well, when you took in the $4,000, you debited cash and you credited deferred revenue, right? That was the hint, right? That was the hint. So we're going to debit deferred revenue. Okay, and that would be for 2,000. And we're going to credit revenue. Now, since it's rent, I would credit rent revenue. And so that was the first one. The second one, again, the date is December 31st. Wolverine purchases a 1-year property insurance policy on July 1st for $13,200. the payment is debited to prepaid insurance for the entire amount. So when you bought the insurance policy, you debited prepaid insurance and credited cash. What entry do you make for the adjustment? In other words, as time passes, the insurance policy has expired, right? So you're going to debit insurance expense. Now, what's the amount? It's a one-year policy that you bought on July 1st. So how much time has passed from July 1st through December 31st? That's 6 months. That's half a year. So 13,200 times 1/2 is 6,600. Debit insurance expense and credit prepaid insurance, right? 6,600. Okay. Number 3. Employee salaries of $3,000 for the month of December will be paid in early January. So what adjusting entry do we make for salaries? We debit salaries expense, right? And we credit salaries payable. Debit salaries expense and credit salaries payable. Okay, so this is number 4 now. On November 1st, the company borrows $15,000 from the bank. The loan requires principal and interest at 10% to be paid on October 30th, 2022. That's a year. That's a year from now. So we bought we borrowed the money on November 1st, but we don't have to pay it back, principal and interest, until October 30th of next year. What are they trying to do? What do they want you to do? They want you to adjust for interest. Debit interest expense and credit interest payable. All right, now we've got to calculate the amount. $15,000 times 10%. Okay, now if you do that, that comes out to be $1,500, right? $1,500. 15,000 times 10% is $1,500. If I take $1,500 and divide it by 12, what does that come out to? 1,500 divided by 12 is $125 a month. And what's the time period that I'm adjusting? I'm adjusting from November 1st through December 31st. That's 2 months. So what's 125 times 2? It's 250. So debit interest expense, credit interest payable for $250, right? Supplies. Office supplies at the beginning of the year were 1,000. On October 15th, they purchased an additional 3,400. At the end of the year, there were only 500 remaining. Now, whenever we see adjustment for supplies, that's a debit to supplies expense and a credit to supplies, right? So what's the amount? We started with 1,000, right? And then we bought 3,400 more. So that means we had $4,400 worth of supplies at one point, but there's only 500 left. So 4,400 minus 500 is 3,900. That's the number they're looking for in the entry, 3,900. And so that was it for that problem, exercise 12. Now let's do exercise 13 also. Which is on the next page. Let's take a look. Below are transactions for Hurricane Company during 2021. So we're going to do the same thing. We're going to make the adjusting entries. It's annual adjusting entries, right? No financial statements were prepared during the year and no adjusting entries were recorded, right? So December 31st is going to be our date. On October 1st, 2021, Hurricane lends, not lends, like, you know, like a bank does, lends $9,000 to another company. The other company signs a note indicating principal and 12% interest will be paid on September 30th, 2022. Okay, now, this isn't interest expense. See, when you borrow money, it's interest expense. But when you lend money, like a bank does, it's interest revenue. Okay, it's interest revenue. Now, revenue is a credit, interest revenue. Now, when somebody owes you money, that's a receivable. So yeah, it could be accounts receivable, but with interest, we like to use interest receivable. So we're going to debit interest receivable and credit interest revenue. Now let's calculate the amount. It's $9,000 times 12%. $9,000 times 12% is 1080, but that's for a year. Right? If we divide that by 12, it comes out to $90 for a month. If we divide that by 12, $90 for a month. How many months are we accruing? The loan was made October 1st. So that's October, November, December. That's 3 months. 90 times 3 is 270. So we're going to debit interest receivable and credit interest revenue for 270. Right? Number 2. On November 1st, 2021, Hurricane pays its landlord $4,500 representing rent for the months of November through January. November, December, January, 3 months, right? It's paying the rent 3 months in advance. The payment is debited to prepaid rent for the entire amount. All right, now pretend that was insurance rather than rent. Debit prepaid insurance, credit cash. Debit prepaid rent, credit cash. Now the adjustment is what? It's a debit to the expense and a credit to the prepaid account. So that's what we have to do here. So we're going to debit rent expense, right? And credit prepaid rent. Right? And what's the amount? The amount is $4,500 for 3 months. That's $1,500 a month. How many months is it from November 1st to December 31st? It's 2. So 1,500 times 2 is 3,000. Okay. Number 3. On August 1st, 2021, Hurricane collects $13,200 in advance from another company that is renting a portion of Hurricane's factory. The $13,200 represents 1 year's rent, and the entire amount is credited to deferred revenue. So on August 1st, they debited cash and they credited deferred revenue. Right? Now, we're the landlord in this case. So we are going to now say how much of that deferred revenue, how much of that rent that was paid to us in advance, that was a liability when we received it, how much of that is revenue now? So we're going to debit deferred revenue, right? Debit deferred revenue. And we're going to credit rent revenue. Right, now what about the amount? 13,200 divided by 12 is 1,100. How many months from August 1st through December 31st? You can count on your hands if you want to, right? That would be August, September, October, November, December. That would be 5 months. 1,100 times 5 equals 5,500. Depreciation on machinery, 5,500 for the year, right? Thank God, that's a simple one. Debit depreciation expense. Credit accumulated depreciation. Salaries for the year earned by employees but not paid to them or recorded are 5,000. Right? Another pretty simple one. Salaries expense. And salaries payable. Number 6. Hurricane begins the year with 1,500 in supplies. Okay, so what do they want? Debit supplies expense and credit supplies, right? You know that's what they're looking for. So let's figure out the amount now. Go back and read. They begin the year with 1,500 in supplies. And then they go out and purchase 5,500. Right now, 1,500 plus 5,500 is 7,000. At year end, supplies costing 3,500 remain on hand. So if they started with 1,500 and added 5,500, that means that the most they had at one time was 7,000. If they have 3,500 left, that means 3,500 aren't there anymore, right? And those 3,500 are what they're looking for. Debit supplies expense and credit supplies for 3,500. Okay, let's do one more. We have time to do one more. Let's do number 14. Let's see. Let's not do number 14. Let's go back and see if we could do number. Exercise 10, page 155. It's just more of the same things over and over again. All right, so let's take a look at that one. Exercise 10. Consider the following situations for shocker. Record the necessary adjusting entries at December 31st. No entries were made during the year. All right, now, November 28th, Shocker receives a $4,500 payment from a customer for services to be rendered evenly over the next 3 months. The deferred revenue account is credited. So on November 28th, again, I don't know why they threw that date at you. I guess they were trying to see if you would, try to get this down to the number of days, right? You don't have to do it that way. November 28th is close enough to December 1st that you would say it was December 1st. So let's say on December 1st, Shocker received $4,500 payment from a customer for services to be rendered evenly over the next 3 months. Deferred revenue is credited. Debit cash, credit deferred revenue. So now what we want to do is we want to show that we earned some of that deferred revenue. So we're going to debit deferred revenue and credit service revenue. Well, what's the amount? How long is it from December 1st to December 31st? It's 1 month. So $4,500 was for 3 months. So 4,500 divided by 3 is 1,500. 1,500 per month. Number 2.
I have a question.
Yes.
What'd you say was debited and credited in that sequence?
The original entry when you got paid was to debit cash and credit deferred revenue. Right? On November 28th, the date they used, you debited cash and credited deferred revenue. Right? Because they told you deferred revenue is credited. Shocker receives $4,500 payment from customer, right? Debit cash, credit service revenue. So the customer paid you in advance for 3 months worth of your services. So now after a month goes by, you want to show that you've earned 1 month worth of those services. So you debit the liability, deferred revenue, and you credit service revenue. Is that okay?
Thank you.
Remember, when you get paid in advance, that's deferred revenue. That's a liability. But sooner or later, you're going to do that work. Otherwise, your customer is going to start complaining. So when you do that work, you debit the liability and you credit service revenue. Okay, now December 31st, the second entry here. On December 1st, the company pays a local radio station $2,700 for 30 radio ads that were to be aired, 10 per month, throughout December, January, and February. Prepaid advertising is debited. So on December 1st, you debited prepaid advertising and credited cash for $2,700. Now a month has gone by. Some of those ads have run. when those ads run, that's not prepaid advertising, that's advertising expense, right? So debit advertising expense and credit prepaid advertising. Now for the amount, you paid them $2,700 to run 30 ads. 2,700 divided by 30 is $90 an ad. $90 an ad. How many ads ran per month? 10. So what's 90 times 10? Right, it's 900. Right, it's 900. 900. Sorry for that. Right, so 2,700 divided by 30 equals 90 times 10 equals 900.
I have my screen is frozen
Yeah.
for me. I don't know if it's everybody else or just me, but my screen, it was a little frozen before. Oh, never mind, we're good now. All right, thank you.
Okay. All right, let's take a look at the next one. Number 3. Nice. You can breathe easy when you see these, right? Employee salaries for the month of December totaling $8,000 will be paid on January 7th. Debit salaries expense. And credit salaries payable. Okay. Last one. On August 31st, Shocker borrows $70,000 from a local bank and notice signed with principal and interest to be paid, principal and 9% interest to be paid on August 31st, 2022. Right. So now you're the borrower, so you have to calculate the interest expense. We're going to debit interest expense, and we're going to credit interest payable. Right, and to do that, we're going to take $70,000 times 9%. Right, now that equals what? 70,000 times 0.09 is 6,300. And if I divide that by 12, right, 6,300 divided by 12 comes out to $525. Now, how many months is it? Now, August 31st, let's say September 1st, right? You don't have to calculate it down to the days. But how long is it from September 1st to December 31st? That's 4 months. 525 times 4 equals $2,100. So we're going to debit interest expense and credit interest payable, $2,100. All right, so that's it. So we covered the homework, right? And then we did some extra work. You know, when it comes to these things, I mean, the more you do, the better you get at it, like anything else. And any questions?
No, I think we're fine.
Go back to the beginning, right? Go back to the basics. Go back to, let's see. Go back to your textbook. Right? Understand when revenues and expenses are recorded. Well, revenues and expenses get recorded every day. However, the problem is when we talk about adjustments, sometimes the expense is something that you use now, but you don't pay for it until later, right? So that's why you have to make an adjusting entry for that. Sometimes the revenue is something that you did now, but you might not get paid for till later. That's why you make an adjustment. Sometimes, as we've seen, right, when it comes to revenue, you could have gotten paid first. You could have gotten paid first and not did any work, and then the adjustment is for the work that you did, right? Debit deferred revenue, credit revenue. So that's the reason why we make adjusting entries, because revenues and expenses they don't always occur in the same time period. This was I guess the procedures, the steps in the process. During the year, you record the external transactions that we learned how to do in chapter 2, right? And now we do the adjusting entries, prepare financial statements, and then close, right? So that's the sequence. The revenue and expense recognition are the principles or the rules or the law, if you want to look at it as a law, that tell us that these are things we have to do. I don't even want to talk about cash basis accounting because we're not going to do it. Cash basis accounting is not considered generally accepted accounting principle, right? So why even bother with it? Okay, and again, this explains some of it. What's the prepaid expenses and deferred revenue? Now, again, remember there were two categories. There were two big categories that I told you about. I said one was called deferrals and one was called accruals. Right? Deferrals are things that have already been recorded but need to be changed. The numbers already exist in the accounts and they need to be changed. That's these two. So if we pay for something in advance, an asset is created. As time goes by, the asset expires, and that's the adjusting entry, debit expense, credit asset. When it comes to deferred revenue, we get paid in advance. Debit cash, credit liability. A liability is created when the services are provided, the liability goes away. Debit liability, credit revenue. The other big category were accruals. Accruals are something's happened, but for whatever reason, it hasn't gotten recorded yet. Okay, so when we talk about accruals, we can have accrued expenses or accrued revenue. Accrued expenses is we used something. A liability was created, but it hasn't been recorded yet. The salaries. Right? Remember we said at the end of September, I think September 30th was a Wednesday, right? But the employees aren't going to get paid until Friday. But if I'm making financial statements at the end of September, I have to include September 28th, 29th, and 30th. What were the salaries that the employees earned in those 3 days? Debit salaries expense, recognized expense, and credit liability, salaries payable. So salaries is one, debit salaries expense, credit salaries payable. Interest was another one, debit interest expense, credit interest payable. And sometimes it's just that we got a bill for something in September that doesn't have to be paid until October. Usually that's something like a utility, right? Debit utilities expense, credit accounts payable. And then eventually that'll get paid in cash, but it won't be paid until the next period. That's what's the key to this. When it comes to accrued revenue, a service was provided. We have to record revenue whenever a service is provided, but because we didn't get paid for it yet, it is a receivable. we increase an asset for the amount to be received. So we're going to increase something like accounts receivable, credit service revenue. We saw in one of the examples that we just did a few minutes ago, when we were the lender, right? Debit interest receivable, credit interest revenue. Right? And then again, it just goes into more detail. Here's an example of prepaid rent, etc. Right? Supplies. Right? So again, I wouldn't spend an over amount of time reading this. I would try to do the entries. And then if you get stuck and you have to go back and read, you know, by all means, go back and do that. But there was something else I wanted to show you. Again, it's in your materials. These notes, right? So these notes kind of explain in a few pages what the book might take 30 pages to tell you. So maybe you want to start with this and try to do some work, have this in front of you. And then if you get stuck, you can go back and read up. But again, like I've told you before, reading an accounting book is not how you learn, right? I mean, in other subjects, yes, you have no choice but to read, to learn. But in accounting, really, you got to do the problems, and the reading is really secondary. But that's it. That's chapter 3. We're done with chapter 3. Like I said earlier, the homework isn't due for a while, right? The homework isn't due till October 16th, so you still have plenty of time to do that. Then chapter 4 is due a week later. Chapter 4 is light. Chapter 4 is very light. So we'll do chapter 4 next week. We may start it and finish it in the same class. All right, keep track of your dates. All right, exam 1 was due last week. Exam 2, October 27th, right? Which seems like a long time from now, but you know, it'll get here quicker than you know. Right, and then the third exam, November 25th. And whenever I see a date like that, I start to think of Thanksgiving, and I start to think of commitments. And, you know, just keep in mind that you'll have an exam due. And the exams are every 2 chapters, right? Every 2 chapters. So you should be looking at this, you know, at least a few times a week to keep track of your dates and, you know, stay in good shape. All right. Is there any questions about anything?
No.
Okay. So, you know, email me if you have a problem, if you get stuck. You know how to get in touch with the Learning Center. Has anybody gotten in touch with the Learning Center? Anyone? Okay, remember, the Learning Center is an option. Go back to the announcements. It's probably the first one, right? See it, Learning Center. If you need help, you email Bob Deanna. His email is right there, and they'll get back to you. All right, guys, so if there's no other questions, that's it for today. I'll post the video, and I'll send you an invitation for next week. All right?
All right, have a good one.
Be well.
Have a good one, Professor.
Thank you.